Welcome to Investors Insights episode number 142. Today we will be discussing, has asset allocation failed portfolios? Did the Fed cause a lot of tension this year in market performance? And will the Fed continue to be a bothersome issue as we go into 2016? And what impact does that have on your portfolio? Now, if you like what we have to say, we always appreciate you contacting us. We know if you don't like what we have to say, you definitely will contact us. And we thoroughly enjoy that. We enjoy the interaction. So let's get started and make sure you jot down notes and have interaction here with us. Give us your opinion. We'd love to hear from you.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy Team at Five Plan Partners. 3, 2.
Guys, good morning.
Morning.
Last week of 2015.
It is. Yes. Big week.
It is a big week. So, and it's been an eventful year.
Yes.
So the other day I sent out a letter to our clients and declared 2015 the year of distortions, a year in which the media reported one thing, but the reality stated another. This has definitely been a year in which asset allocation has not been effective. Every asset category at some point throughout the year has been hit from a negative standpoint. So I know I've spent a lot of quality time with the two of you in terms of late at night as we've watched how to maneuver through these markets and looked at strategies. And it is definitely one for the record books. There's no doubt about that. Now, Bobby, I think we had a question from one of our clients regarding the Fed. Talk a little bit about that. We talked about that earlier this morning.
Yeah, so this year we've been saying for months that it's been the year of uncertainty and distortions.
Yeah.
And one of the clients that we have, we appreciate this question, but the question is, she wanted us to elaborate on what we mean by the Fed causing the uncertainty.
Right.
And so I think the best thing to do is kind of go over a timeline of this year, because when Janet Yellen and the Fed speaks, Wall Street listens.
Mm-hmm. Right.
And so, for example, on January 28th, the Fed removed the phrase considerable time for when it will raise rates. The Dow drops 200 points.
Right.
March 18th, the Fed ditches patience, but says economic growth has moderated somewhat. Dow is up 227 points. April 29th, the Fed says economy slowed during the winter. Dow is down 75 points. June 17th, the Fed leaves the rate untouched and says the pace of jobs gains picked up. Dow's up 31 points. July 29th, the Fed displays calm despite global concerns, saying economic activity has been expanding. Dow is up 121 points. September 17th, the Fed says they are monitoring developments abroad, sending shivers down Wall Street's spine.
Right.
And the Dow goes down 65 points. October 28th, concerned about weak job growth,
Right.
and they will reassess progress, both realized and expected. For investors, no rate hike for now is a good thing. Dow is up 200 points.
Sure.
And so 3 days before the Fed raised this December, the market was showing strength, and then 2 days after, it basically crashed and lost all of its gains. Mm-hmm. And so it's been a roller coaster ride based on what the Fed has said all year. And so that's what we mean by the uncertainty. Uncertainty basically equals volatility.
Sure. Yeah.
And that's what we've seen all year long.
It's
Right.
people repricing long-term borrowing costs. They don't know what they're going to be because they could change next month.
Right.
The Fed raises rates. It
Right.
immediately impacts short-term interest.
Yeah, well, it impacts business across the country. People don't borrow money. Banks don't know what decisions they need to be making.
The currency market's huge impact on business,
Right.
how you hedge, the cost of that hedge. Most of that's in the short-term markets.
Right. Yeah, I mean, this year in some ways has reminded me of 1994 when there was a big debate about changing healthcare and healthcare expenses for businesses.
Right.
And there was also the big debate about interest rates in 1994. And the example I've always used is that it's like someone blew up a balloon, pushed it underwater, and those topics were holding down the markets.
Right.
And it was only once those issues were solved it was like the balloon. If when you release a balloon coming out of the water, it shoots up. Mm-hmm. And so there's a lot of positive things going on in this economy. The problem is we need the leadership, the guidance, and the economic data to be able to show that.
2016 is looking like it's going to be another another unknown market. I think the Fed said they're going to raise rates 4 times. The market is pricing in 2.
Right.
You know, that
Sure.
shows a lot of unnecessary.
Well, there's still a lot of people that believe the Fed shouldn't have raised rates at all, even this year. So, and you know, at the first of this year, we said it would be a while before the Fed would raise rates, and here we were at year end. So, Trey, also talk about the good old Uncle Sam has to finance this government.
That's right.
And so talk a little bit about the debt issue that you brought up earlier this morning.
So we talk a lot about monetary uncertainty. We've also had a lot of fiscal uncertainty. And then late last week and late in the year, we've had some fiscal uncertainty taken off the books, but that kind of doesn't paint a pretty picture. Now we know roughly what's going to happen. Doesn't look that great. So the budget deal is going to pull some GDP spending forward. You should see GDP rise by around 0.75%.
This is government spending.
Thanks to government spending.
Not business spending, but government spending.
Exactly. And you know, the government doesn't necessarily have their own money. They do print money, but they've got to borrow typically. And so the current CBO, Congressional Budget Office, projects that next year the deficit will be $414 billion. Based on the new budget, if you look through the details of the new budget, it will actually be around $634 billion. That's an additional $200 billion in supply of debt. Now, where that can impact markets, typically the markets are mostly impacted on the long end. The Treasury is expected to issue more short-end paper because our short-end paper yields higher than the rest of the world. For example, in 2014, foreign private buyers added $161 billion to their U.S. Treasury holdings. That's not governments; that's individuals, and that's because they can't get any yield. So that's where where the increased debt could be eaten up is these foreign buyers, and that's what we'll have to be watching closely is how is that debt issued, and that'll be interesting to see in the first part of the year as corporate tax returns come in, and how much debt is actually needed, along with who's buying, because we know foreign governments are actually selling because of oil being down and China's slowdown, and so it's these individual buyers, and also the unintended consequence positive of the Dodd-Frank bill. Banks can no longer own risky assets, so they're left with only treasuries, and so they're buying these short-end treasuries. They're eating up that market, and so that's another, the supply and demand of the market will be a very interesting thing to watch early in the year.
Absolutely. Well, and that's one thing that we discussed. We think bonds are going to be one of the big topics as we go into 2016. We think there will be opportunity there. At the same time, there may be some volatility.
You see a lot of mispricing that creates opportunity if you take advantage.
Right. And then on the equity side, there's still a lot of positives there too as we go into this next year. So on that note, we will be keeping you updated as we wrap up 2015 going into 2016. Please keep your questions coming to us, and as well as discussion and debate. And hopefully you can tell we're lining up for a happy new year and hopefully a profitable 2016. Thanks.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.